It's the moment your heart begins to race. You see a stock that has been doing nothing for weeks, maybe even months, suddenly ignite. A single powerful bar of price action erupts upwards, leaving everything else behind. Your first instinct is pure, unfiltered impulse. You feel you are late. You feel the train is leaving the station and you are the only one left on the platform. The fear of missing out, that powerful primal urge to chase, screams in your mind. It tells you to buy now, to get in at any price before it's too late. This single moment, this emotional reaction to a sudden display of power, is one of the most dangerous and most revealing points in the entire market cycle. It is where fortunes are made by the patient and where capital is eroded by the impulsive. What you are witnessing is often called a sign of strength. But understanding what it truly is, and what it is not, is the difference between participating in a professional campaign and becoming fuel for one. A sign of strength is not just a big green price bar. It is a specific event, a piece of evidence that tells a story about the hidden battle between buyers and sellers. To read this story, we must look at two things: the spread of the price bar and the volume associated with it. The spread is simply the distance between the highest price and the lowest price during that session. A wide spread means there was a significant and decisive move. Now, couple that with volume. Volume is the number of shares traded. It is the effort. Price movement is the result. The core principle here, one of the fundamental laws of the market, is the harmony between effort and result. Imagine trying to push a very large, heavy boulder. If you apply a massive amount of effort, a huge push, and the boulder moves a great distance, then the result is in harmony with the effort. It confirms your strength. This is exactly what a sign of strength bar shows us. The volume is the effort, a huge number of shares being traded. The wide upward spread of the price bar is the result. The price moved a great distance. This harmony tells us something crucial. The demand, the buying pressure, was so immense that it easily absorbed all the selling pressure at every price level and kept pushing higher. It is a public declaration by large operators that they are now in control and are ready to move the price. It's a footprint of smart money. They are no longer hiding their intentions. They are actively marking up the price. Conversely, think about what happens if the effort does not match the result. If you see a massive spike in volume, an incredible amount of effort, but the price bar is very small, or it closes far from its high, what does that tell you? It tells you that despite the huge buying effort, there was an equally huge amount of selling pressure that stopped the advance. The boulder barely moved despite the massive push. This is not a sign of strength, it is a sign of conflict, of churning, and often a warning that distribution is occurring at that level. Similarly, if you see a wide price spread upwards but on very low volume, that is also a red flag. It's like the boulder moved a great distance with only a tiny push. It's suspicious. It suggests there was no resistance but also no real conviction. This can be a trap, a move designed to entice uninformed buyers before the price reverses. The true sign of strength requires both components, the wide spread and the high volume working together, confirming each other. To visualize this correctly, you must see it in context. Imagine a long, flat, boring period on a chart where the price is moving sideways in a narrow channel. This is what we call a trading range, or an area of accumulation. It's a period where large institutions are quietly buying shares without alerting the public. They buy a little, let the price dip, buy some more. For weeks, nothing exciting happens. The market feels dead. The public loses interest. Then one day, from the right-hand side of this flat range, a single bar explodes upwards. This bar is perhaps 2 or 3 times taller than the average bar within the range. It closes near its absolute high, showing no weakness or selling pressure into the close. Now direct your attention to the volume indicator below the price chart. During the quiet sideways period, the volume bars were small, like a low fence. But underneath this one explosive price bar, the volume bar is a skyscraper. It towers over all the recent volume, confirming that this move was backed by immense financial commitment. This is the jumping the creek, the moment the price leaps over the area of resistance. The sign of strength is the proof that the period of quiet accumulation is over, and the next phase, the markup phase, is likely beginning. It's the starting gun for a new uptrend. So how does a disciplined speculator operate based on this information? The first rule is that one bar is never enough. A sign of strength is a piece of evidence, not a complete trading plan. The novice sees the bar and chases it, buying at the high out of pure emotion. The professional sees the bar, acknowledges it, and then waits. The plan is built on patience and confirmation. Here is the algorithm. First, you must have the proper setup. The sign of strength is most powerful when it emerges from a well-defined cause. This cause is the accumulation phase we just visualized. You must look to the left of the chart and see a period of sideways consolidation. The longer this base-building period, the more significant the potential uptrend. This is the law of cause and effect. A small cause can only produce a small effect. A massive, lengthy cause, a long accumulation range, can produce a massive, long-lasting trend. So, the first step is to confirm the context. Is this sign of strength appearing after a long downtrend and a solid base has been built? If so, the evidence is strong. If it appears randomly in the middle of a choppy market with no prior cause, it should be viewed with suspicion. Once the setup is confirmed, we wait for the trigger. While it is possible to enter a trade during the sign of strength bar itself, it is an aggressive tactic that carries higher risk. The price is moving quickly, and your entry might be poor. A more prudent approach is to wait for the bar to close. A strong close near the high confirms the buyers were in control for the entire session. An even more conservative and often safer trigger is to wait for the subsequent price action. After such an explosive move, the market often needs to pause and catch its breath. There is almost always a pullback or a smaller sideways consolidation. This pullback is your opportunity. We are looking for what is called a last point of support. This is a minor dip after the breakout. The key is to watch the volume on this dip. If the price pulls back on very light, drying up volume, it is a massive confirmation. It tells you that there is no significant selling pressure coming into the market. The sellers are exhausted or absent. The large operators who initiated the sign of strength are not selling. They are holding their positions. This low-volume pullback to the top of the old trading range or to the midpoint of the sign of strength bar is often the highest probability entry point. You are buying the first test of strength after the breakout with evidence that supply is gone. Now let's address capital protection. A trade without a stop-loss is not a trade, it's a gamble on hope. The placement of your protective stop is not arbitrary. It should not be based on how much money you are willing to lose. It must be based on the market's structure. It must be placed at a logical point where, if the price reaches it, your entire thesis for the trade is proven incorrect. When trading a sign of strength pattern, there are a few logical places for a stop. An aggressive stop can be placed just below the low of the sign of strength bar itself. The logic is that if the price breaks below the low of that powerful buying day, the immediate bullish momentum is lost. A more conservative and structurally sound stop-loss would be placed below the low of the recent pullback, the last point of support. An even safer stop, giving the trade more room to breathe, would be placed below the entire recent consolidation area from which the sign of strength emerged. If the price were to fall all the way back down and break below that entire accumulation base, it would indicate that the breakout was false and the entire bullish campaign has failed. Choosing which stop to use depends on your personal risk tolerance and strategy, but it must always be anchored to a structural point on the chart. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Of course, the market is a dynamic environment, and things do not always unfold as perfectly as described. We must consider the alternative scenarios. What happens if you act on a sign of strength and the market immediately turns against you? The most common failure pattern is when a seeming sign of strength is actually a buying climax. This often happens not after a long, quiet base, but at the end of a very long, obvious uptrend. The public is euphoric, the news is fantastic, and everyone is piling in. A huge price bar appears on massive volume. But this is not initiation. It is exhaustion. The volume represents the final frantic buying from the public being met with massive, coordinated selling by the professionals who have been riding the trend all along. How can you tell the difference? Context is the first clue. Is it happening at the start of a move or at the end? The second clue is the follow-through. A true sign of strength is followed by controlled pullbacks on low volume and then further advances. A buying climax is often followed by a stall. The price churns, it cannot make new highs, and the next few bars are weak, often closing back in the lower part of the climactic bar. The massive volume was not demand taking control. It was the transfer of ownership from strong hands to weak hands at the top. Another variation is the failed breakout. You get a beautiful sign of strength bar that breaks out of a trading range, but on the very next day, the price collapses right back into the range on equally high volume. This is called an upthrust. It's a classic bull trap. The move was designed to lure in breakout traders, trigger their buy stops, and then sell to them as the price is reversed. The key to surviving this is your stop-loss discipline. If you entered on the breakout and the price falls back into the range, your premise is violated. There is no reason to hold on and hope. The professional accepts the small loss and moves on. The uninformed participant holds on, convinced it will turn around, and their small loss turns into a significant drawdown as the price begins a new downtrend. The market has given you a clear signal that your thesis was wrong. It is your job to listen and obey that signal without emotion. So, the sign of strength is more than just a pattern. It's a window into the market's soul. It reveals the intentions of the largest players, but it is a signal that must be read in its proper context. It requires confirmation. It demands a plan for entry, for capital protection, and for dealing with failure. Chasing that initial emotional impulse is the path of the crowd. The path of the professional is to see the signal, wait for the dust to settle, and enter at a point of low risk and high probability. You are not trying to catch the exact bottom or the exact top. You are trying to participate in the thick middle part of the move, where the trend is clearest and the path of least resistance has been established. The sign of strength is the event that clears that path. In summary, the next time you feel that jolt of adrenaline as a stock explodes upwards, take a breath. Turn off the emotional part of your brain and turn on the analytical part. Ask the right questions. Is this move supported by a massive increase in volume? Is the result in harmony with the effort? Is this emerging from a solid cause, a period of preparation, or is this happening after a long, extended run fueled by public excitement? What is the follow-through action? Does the price hold its gains and pull back professionally on low volume? Or does it stall and show immediate signs of weakness? By learning to dissect this single powerful bar, you are learning to read the language of the market itself. You are moving away from guessing and hoping, and toward a systematic approach based on the observable evidence of supply and demand. This is the only foundation upon which a durable trading career can be built. if you want to continue learning to decipher these messages, to understand the subtle but powerful stories the market tells us every day, then continue to follow this work. The journey is long, but the understanding it brings is invaluable.